Let's look at all of these stocks. Each bubble represents a company in the S&P 500 index. Larger bubbles are larger companies according to their market cap. The animation shows basically what happened in 2020. So if we start off with February the 19th, by then the stock market was up about 5%. You can see a lot of the stocks. Notice how they congregate. Some of the bigger cap companies in certain sectors like technology were already moving things up ahead a little bit, okay? By the time you get to March the 23rd, and we'd hit the bottom of the pandemic, you see things dropping sharply. Now, the kind of companies I want when the market drops like that are the type which don't fall as far. They've got greater buoyancy or resilience. I don't want the ones which drop like a brick. Which ones tend to drop like a brick? Well, it's dependent on the market cap of the companies, and it was dependent a lot also on the sectors they were in, industrials, for instance, and so on. So I want the ones which have got greater buoyancy. And how do I find that? Valuation was a key factor. Revenue growth was. Cash flow was. Their past track record of volatility was. The less volatile they were, the less volatile they were to become. Okay, and their average returns, stronger the average returns, wasn't the only factor, the more likely it was to continue. Okay, when taken in conjunction with everything else, right? So it was a multi-factor model, as you'd expect. So what happens by the time of June the 8th? Well, by then, we've seen some reflation in the market, and what happens? The more buoyant stocks, think of when you try and put those life vests, force them down. What happens? You let go, boom, they go upwards very sharply. And indeed, by then, you saw once again the companies. Yes, it was sector dependent, but it was also within those sectors companies which had good cash flow, revenue growth, valuations. Those were critical factors for that resumption and outperformance. And you saw the likes of Apple touching 100% return as a result. The mistake most people make is they think it's to do with, I think we'll guess it's going to be industrials next. I think it's going to be technology. I think it'll be financials. Of course, that might help if you manage to guess it right. But in actual fact, the starting point is valuation growth, income, cash flow, the track record, or what I might call the Sotino, the average return and the consistency of that return, all taken together, were better at forecasting that it was going to be technology and those kind of companies, rather than going the other way around and saying, I wonder which sector it might be. I wonder what market cap, how big the bubble is it might be. Will it be bigger bubbles, smaller bubbles? Will it be a particular sector or not? So it's very important to do it the right way around, and last year proved it. And we'll get other falls again, where you saw that sharp fall. The financial crisis, those bubbles and crashes will happen again, and people will make the same mistakes again. I'm not saying technology will be the answer. What I'm saying is it'll be the companies which, again, will have cash flow, valuation, growth, income, or dividend yields. Because things like dividend yields, to take an example, stop the company falling too far down. You can't push it down too far, otherwise the yields tend to go up. And yet, when the rest of the market resumes, boom, they tend to grow, as long as we've got growth and valuation we're looking at as well. So we're not trying to guess a style. We're going to pick things with all those styles within them. That should give a different explanation of basically how I tend to select stocks. And if you followed my webinars and so on, you'll know since we were doing them, if you look during this whole period of last year, they're on YouTube and everywhere else, you'll know this is not just hindsight talking.